Welcome to yet another fundamental analysis. I'm once again joined by Kirill, and today we're gonna go into Evercore. And Evercore is a company that both Kirill and I have been holding for a long time. I believe over a year.
Yeah, that's
Um,
that's more than a year for sure. Yeah.
yeah. So basically, we'll tell you more about it. So what we're gonna go over today is the company description. What do they actually do? We're gonna give you the fundamentals of the company to see whether it's strong or not, when they have strong financials at least. And then we're also gonna give you a nice valuation afterwards. But keep in mind, this is not financial advice in any way, shape, or form. Please read the disclaimer in our description. Always do your own due diligence before buying any security. So yeah, let's dive right into it. So as I mentioned, we're gonna discuss Evercore today. And they're an advisory firm and consulting firm specialized in merger and acquisitions, and they also offer some other services such as investment management. Do you have anything more specific to add, Kirill,
Yeah,
to
it's
that description?
something like, yeah, for people who are not very familiar, it's not, let's say, a house name, Evercore, and it's not something very famous and eye-catching. But you can compare it to something like the Big Four, but without the part where you have the audit. So they're mainly specialized in actual consultancy on the strategic level, and especially their bread and butter, as Robbin mentioned, is mergers and acquisition deals. And what it means is that pretty much the company is very great when the economy is doing well. So it means that people and companies have enough money to actually, conduct these kind of deals and then spend this money on these kind of services. But when the economy is not doing that well, then probably the demand for the services also slow down. So that's something for you guys to keep in mind if you would
Yeah.
like to look into it.
But then also, on the other hand, they also have restructuring advisory. So again, if the company is doing poorly, they have products to sustain it. And also, why we're covering it is because they outperformed the analysts with their Q3 earnings, and that gave them a bit of a boost in the share price.
Yep.
So yeah, given that, we can now look into Evercore into our own spreadsheet. Yeah. So whenever you open a spreadsheet, you're always immediately greeted with some of the statistics and the ratios that might be interesting for you to see up front, right? So in this case, the market capitalization, PE ratios, whether or not the revenue has been growing, share buybacks, their dividend yield, and also if you're interested when they pay out their dividends. Yeah. So, Kirill, you see anything interesting here?
Yeah, and also on top of that, you can see the gross margins of almost 100%, as well as the return on invested capital of almost 23%. That's a definitely good signal. So it means the company has well established and well managed operations, right? And because it's asset light business model, makes it very lucrative in terms of, like, for example, providing share value to shareholders. So in this case, Evercore prefers to do it through the share buybacks and through the increase of its dividends. So you can see, if we go to company foundations, for the past 5 years, the company has been increasing its dividends by almost 14% annually, which is quite a good result, I would say.
Yeah, exactly. And then also we can, while we're at the foundations, we can see some of the check marks you would like to see. So revenue growth, net income growth, that their long-term debt is covered by their free cash flow. The share buybacks are really important for you as an investor because it means that your shares generally become more valuable because they small in the pool of shares outstanding. And then we also have the dividend growth, which you already mentioned. So that's of course a good sign to see that they having giving away more capital to the shareholders because they don't feel like that the company needs it to be, that need to be kept inside the company. But then we see one red flag, which is the free cash flow growth, and we can see if we go a bit down where
Yep.
what might be happening. So here we see that their cash flow had been growing steadily. Um, well, we see it drop between 2018 and 2019, but it has been growing steadily ever since. But they had a drop between 2021 and 2022.
Yeah, I,
Um,
I guess my guesstimate would be just because of the rising interest rates, because what I mentioned in the beginning, that the company doesn't have like a steady growth, like for example Visa and Mastercard has, right? It's just a matter of like increase in the number of transactions. Here, if there's more activity in terms of the mergers and acquisitions or restructuring, right? So that affects the company's business as well. So when when the economy is experiencing the turmoil, it might have a little bit of less business coming up. But if we expect, for example, for a company to get a great comeback when the economy is gonna get better, maybe in sometime in the future, soon, then you can bet that these financial metrics are going to improve.
Yeah, and then also, of course, we understand that 2022 was quite a volatile year, right?
Yep.
With wars raging,
Yep.
and yeah, just global scale events happening that affected the market.
Yeah.
So
Exactly.
then also their business.
Yep. Okay.
Um, yeah. So let's continue.
Mhm.
So for the other statistics, some really good numbers here. Their net earnings ratio of around 20%. It's also in the ballpark of where you would like to see it, right? So
It's
very
on
good stuff.
par with market. Exactly. Yeah.
Yeah. Research and development is good that they have zero. Also, it's yeah, as Kirill mentioned, it's just basically a consulting firm, so they don't really have something to develop.
Yep.
So yeah, and the selling in general is at zero as well, which is good to know. It basically means it sells itself. Um,
Exactly.
they probably have some marketing activities, but it's so marginal that yeah, it doesn't show. For the depreciation, it's also really low because they don't have any inventory, for example, that is depreciating. Maybe some PCs or something that need to be on there.
Yeah.
Um, yeah, and then their free cash flow per share outstanding is a bit volatile, but then again, it's also in line with how volatile their free cash flow has been in general.
Yeah, and then you can also see like if that assumption holds, that the company, yeah, is going to experience way more growth opportunities when the market is going well. So for example in 2020 and 2021, right? But as soon as the interest went up in 2022, you can see the free cash flow growth went down, the revenue growth decreased, and the net earnings growth as well. So yeah, something for you guys to keep in mind. But then again, if we take the averages, it's still quite good. So free cash flow is growing at 12%, revenue is at 10, so it's above the inflation rate. So I would say it's something good. At least it's not in negative.
Yep, yep. So that's really good to see. So then we'll start looking at some other um, yeah, statistics, but also something that we already covered, right? So the free cash flow growth, for example, the revenue growth over the past years.
Yeah,
Um, yeah, again, we see similar effects with the free cash flow when it's decreasing, and then also we can see that same pattern with their just revenue growth and their net earnings.
yeah, exactly.
But something really good to see is that they have an insane shares outstanding change. So meaning that they buy their share buyback strategy is pretty decent. I mean, they have been buying back shares -5%, -1%, and again -5%.
Yeah,
They diluted the shareholders with 2%, but if you see these numbers, it's not really a big deal in my opinion. I
yeah,
don't know
I
if you have
agree.
anything to add. Yeah.
Yeah,
And then the dividend growth is just also really interesting and also yeah really advantageous for shareholders. So 25%, 10%,
yeah.
whatever it is.
Yeah,
Good
so
to see.
as a dividend stock, this is something like, these signals are very good to see for sure. So if you're a dividend investor, you might consider it, to put it in your bucket, or at least in the watch list for the future. So shall we move on to the funniest part, the most
Yeah,
exciting one? Yeah.
that's
Okay.
good.
Yeah. So as we've discussed, let's say the average revenue free cash flow growth for about 13% for the past 5 years. But we can also just check, let's say, what it has been for 10 years, right? To get for a bigger timeline. So we just usually go to stockanalysis.com and you just plug in Evercore, and then you would just go to the cash flow statement and scroll all the way to the bottom. And then here you can just quickly highlight the time frame of about 10 years. You can just copy paste it here, and surprisingly enough, the free cash flow growth for the past 10 years, it's been 26%. So this is quite good.
Yeah, but there's also, of course, a bit of yeah, with averages, it's always a bit, iffy on where it's coming from. So we can already see like some insane increases and decreases. So like 71%, 73% increase in free cash
True.
flow, or at least positive change, 130%. So I don't think
True.
it's a very realistic pattern to adhere to. But we can
Yeah.
also check out what the analysts are thinking, right?
Yes, so if we go, for example, to Yahoo Finance in this case, we'll go to analysis, and then you can scroll down here and find what the analysts, the professionals are thinking about the growth for the company. And they are, yeah, this is also all over the place. So for the current year, they expect negative almost 50%, right? But for the next year, plus 75%. So this actually matches with the assumption that, like, if the economy is growing, the company is going to do way better.
Yeah.
Um,
But then also the next 5 years are then -4%, which is kind of
yeah, but to be honest, I
so.
don't really expect that.
No, me neither. It's yeah. So maybe in the worst case scenario would say like, okay, let's keep the past 5 years.
Yeah, so
Like,
maybe about 10%. I would say
yeah,
10% is something.
yeah,
Yeah, I would rather find reasonable, because also the past 5 years have also been quite turbulent, economically speaking. So that could be like a good estimate if still the economy is not going to be doing well in the upcoming 5 years.
yeah,
But then again, this is also our estimate, and we cannot predict the future, of course.
exactly. Yeah,
Um. mhm.
and yeah, and then for the PE ratios, we also always go to microtrends.
Yes, so the same drill, just plug in Evercore, and then what we can see here. So for the past 5 years, the low was about 7, and the high was about 20.
Mm.
So we can just plug it in here. So 7 and 20. Required rate of return, what do you usually put there?
Required. Yeah, so most of the time just around 10%, just for the fact that, yeah, right away. Or at least you can also do some higher, like 12%, because you would expect the S&P to return annually about 7 to 10%.
Mhm.
But because you're stock picking and having that higher risk, you also want some higher rewards, right? So 10, 11, 12% would be, I think, a decent required return of return.
Okay, let's just do 12 then. Yeah, and for margin of safety, I would probably bump it up to maybe like 20 or 30%, right? Because it's also not. Yeah, let's say the business model is great, and the way how we operate the business is great, but then again, because of the fact it's prone to these kind of volatility, it's good to have some margin of safety, I would say.
Exactly. I agree.
Yep. So if we put 30% here for the discount cash flow formula, it's quite different from like our usual tech stocks we have a look into, right? Because let's say the services the company offers, they're going to be there regardless. There's going to be changes in landscape, but these companies would still hire Evercore for its M&A services and advice, and doing all these strategic consultancy. So I think I would keep 10 years of the horizon here. That would be fair. What do you
I
think?
guess so. Yeah, I agree. Totally.
Okay, cool. Now, we just hit the analyze button and see what formulas are there, and what's the target buy price we can look at. And yeah. Also, guys, keep in mind just one more time, this is not a financial advice, and this is also just a screener tool which you can use and have a look at. But then just make sure you do your due diligence later.
Alright, so yeah, what do we see now? We see quite a good valuation, right? Because what is the current price of that, of course, like $144? Yeah, 141 exactly, so you can see it on the left, and then the average valuation is 190. But if you also want to consider the marginal safety, you would like to maybe start building your position around $135, let's say. I would say it's quite good to the current market price, so yeah. Exactly, I think it seems at least, yeah, if you want to get in, it might be close to this, yeah, some point that you might exceed for my position. Would you also like to go over on the fund Smith ratios? Because normally we do this and now we skip them, so it might be good if you want to know why. Yeah, I can just walk you through guys real quick. So the thing is that because of the fact that Evercore is a company which has more of like an investment banking kind of reporting structure, some of our let's say calculations might not be applicable to different types of let's say companies. So for example, that's why you can see that return on invested capital or the cash conversion or interest coverage, they're like providing blank results, right? So you can just disregard that. This is also applicable to quite a few banking companies. So they're because of the fact that they have different reporting structure. So if you're gonna look into it, just make sure you again, just double check and just do your due diligence. So this is a little bit wrong, and this is also something what we're going to be working on in our web application, which is hopefully also coming up soon. So yeah, stay tuned. And anything else?
Yeah. So where can the viewer buy this sheet, and also of course the web application in the near future?
Yeah, so you can just go to our website, which is called 930.com. Looks like this, and then you just go to the page Get Access Today, and the deal is simple. So let's say our idea is that we just want to make investing easy and accessible to everyone, and that's why for all the people who just like to give it a spin, we're just gonna only give it for €1. That's it. So hopefully it will just provide you quite a good value in terms of, you just make more educated decisions when it gets to investing. And if it's worth only €1, then I hope this would be a great value for you. And then in the future, for the first 100 people, it's gonna stay like that, so €1. And then all the future updates when we're gonna have a web app, it's gonna be the same for free. So we just want to really start building the community around this topic, and just make sure to bring the people with the same ideas, and just share them, exchange them. So yeah, something like that.
Yeah, sounds good. Well, thank you again, Kirill, and thank you for watching. Make sure to subscribe and like the video if you did. Check out our tool, and then we'll see you in the next video.
Bye.